Don't miss this super opportunity. Call us today on 097 77 71898, 0957 944469, or 076 6600 You can also email us at mckennyheights@gmail.com. Better still, come in person and see what we have at plot number 88 of Salim Drive, Makeni, Lusaka. Makeni Heights, home ownership at its best.
Not to simply exist, but to move ahead, to rise up and achieve, to conquer. Introducing Kung Fu Energy Drink, your push for the next conquests. Kung Fu Energy Drink, master the power.
Good evening. Thank you so much for joining us for this special edition of Diamond Live. Tonight we take a closer look at the 2026 national budget and Zambia's public debt management. The 2026 budget themed consolidating economic and social gains towards a prosperous, resilient and equitable Zambia amounts to 253.1 billion kwacha, a 14% increase from last year. However, nearly one-third of this budget will be allocated to debt servicing and arrears, totaling approximately 78 billion kwacha. Now, as Zambia nears the end of its 38th month IMF program and finalizes debt restructuring, questions remain: are we consolidating gains or deepening fiscal strain? To discuss this, we're joined in by Mr. Robert Mwale, the coordinator for the Civil Society Debt Alliance. Thank you so much for joining us. My name is Andrew Mwansa.
And my name is Jumwega Chileshe. And indeed, good evening to our guests tonight. Thank you so much for joining us on the Diamond Live tonight.
Thank you, Jumwega. And thank you for having me.
I know that, Andrew, we're still commemorating Zambia's 61st independence. I don't know if you have any message, really, for our 61st celebration as a country, really.
No, I think after 61 years of independence, I think we still have grappling with a lot of challenges. Our total public debt is sitting at over 650 billion kwacha, and then we are now channeling about a quarter, 30% of it towards debt service. And then that seemed to pose a lot of challenges on our people, and that is really the challenge that we are seeing, and this shouldn't be the case.
So, are you saying there's nothing worth celebrating? 61 years of Zambia's independence?
The much of the things that we can point out to that we may need to have a discussion on. I think what we are supposed to see after 61 years of independence, we are supposed to have more control of much of our resources. Our debt issues were supposed to be under control, and we were supposed to see a situation where our people are actually impacted in a much positive manner from their resources, and I think those are some of the issues that poses a lot of questions when we look at the 61st independence that we're just from celebrating.
Indeed. Now, this program was produced with the financial support of the European Union and the German Federal Ministry of Economic Cooperation and Development under the GIZ Enabling Access to Justice, Civil Society Participation and Transparent program. Its contents are the sole responsibility of civil society organizations, Debt Alliance, and do not necessarily reflect the views of the EU or BMZ. Like I said earlier on, our guest tonight is Mr. Robert Mwale, the coordinator of the Civil Society Debt Alliance, and we're discussing the 2026 national budget and Zambia's public debt management. And the beauty for this special edition of this program is that you are welcome to participate by calling us on the number that is on your screen, or alternatively you can use our social media platform where this program is streaming live. You can drop your comments in the comment section. Before we can get to the details of why we called you tonight, Mr. Mwale, briefly tell us about the civil society organization Debt Alliance.
Okay, thank you so much, Mwansa. The Civil Society Organization for Debt Alliance is actually a coalition or a group of civil societies that came actually together in 2020 when we saw that we were almost defaulting on our debt. And I think the purpose of the civil societies coming together was actually to offer guidance around issues of debt management, as well as also to be a part in giving the advisory services around issues of debt restructuring, and also hold government accountable in terms of issues around transparency. And I think this is the work that we have been doing for the last 5 years. We have worked around generating evidence. We have worked around bringing together different civil society organizations to actually discuss issues around debt, and we have actually provided a lot of advisory services to just state the state and how best we can navigate the challenge that is before us. Yes.
When you speak of evidence, please just quantify more on that. Just qualify more on that when you talk about the evidence that you've also been able to garner and gather for people to make reference to.
Okay, so what you're going to note is that currently the CSO Debt Alliance is being chaired by the Jesuit Center for Theological Reflection, and then we are holding the secretariat at the Center for Trade Policy and Development, that is CTPD. So mainly our role is to generate evidence that is in the area of research, based of looking at what are the trends, what are the global practices, where are we in terms of how we are managing our debt, what is it that we can do different, and this we've done through research, generating policy briefs, and all this information, then disseminating that information.
If we have to be more practical, what is your evidence able to prove right now, based off the current trends and where we're at as a country?
So from the evidence that has been gathered now is that our debt levels are still unsustainable because we are beyond the threshold that we must actually be, that is 65% of our GDP. And furthermore, our evidence actually reveals that from the time that we defaulted to now, our repayment amount has still remained relatively around 30% of the total budget. Furthermore, the evidence shows that what we have done is that we have not really dealt with the problem of debt through the restructuring, but what we have done is that we have actually gotten a bit of headroom to have some sort of fiscal space for government to navigate and undertake some expenditures, especially in the social sector. But what you're going to notice is that we have not actually dealt with the problem at hand. So basically that is what you will note from the evidence that has actually been gathered.
I don't mean to get political, but the fact of the matter is that because out of a democratic dispensation, we do host people of different political views and narratives. And one thing we've noticed is we've hosted different people, especially from the Patriotic Front, who have argued that the debt portfolio or the debt position under the UPND is actually worse than it was under the Patriotic Front. Do you agree from your evidence? Because you say you've gathered an evidence and you have all of that.
Okay.
Do you agree with that narrative?
So from the evidence that is there, what you're going to notice that between 2012, if we start from 2012 to 2025, where we are at. So what you're going to notice that our debt levels were sustainable up to 2016. From 2016, our debt levels became unsustainable. We borrowed to the excess of about 130% of our GDP against the global standard of 65%. But what you're going to note is that from 2021 to 2025 is that our debt levels, what you're going to see from the trend is that is declining. So what that tells you is that from 2021 to 2025, there is some sort of fiscal consolidation, because what you're going to notice is that our fiscal deficit has actually been declining from a double digit that it was in 2021 to a single digit around 3.7. That is what we closed with in terms of last year. So what we're going to say is that in terms of handling issues around debt, when we compare the two regimes, you are going to note that there seem to be some levels of discipline with the current regime compared to what was observed between 2016 and 2021. And then people have argued that perhaps one of the factors that could lead us to where we are issues around the extended credit facility that we got from the IMF, because part of the conditions that were there is that we could not actually have access to the market, the external market for us to borrow. So basically, we are limited to depend on the concessional loans from the IMF. At the same time, sorting out the other deficit on the domestic market.
Do you agree with that school of thought?
So basically, what you're going to note is that there is some level of discipline. What would actually be much of a test to see whether this is the path that this current administration has decided to take on, is that beyond the restructuring would have given us a proper test, and seeing that next year is an election year, I think those are some of the tests that we hope to see if this is truly fiscal discipline or otherwise.
One of the arguments that's there from the opposition is that, I mean, the UPND government prior to being elected spoke highly against how the Patriotic Front was borrowing. But they still argue that if we actually look at it in detail, the UPND has borrowed more. I know you speak of fiscal discipline, but do you agree with that?
Data shows a different picture. Yeah, data shows something else. So what data...
the argument is that they've borrowed more than they can account for. Because the PF say that they borrowed and they're able to point at infrastructure, they will point at this and that, but they feel that the UPND have borrowed for what people cannot really see.
Okay. So what it is that after we defaulted in 2020, what had happened is that Zambia had no access to the external market because you could not access finance there. So we went into a program of trying to have our debt restructured. And in the process, we brought IMF on board through the extended credit facility. And that facility, we accessed around $1.7 billion. And then much of it went to the foreign reserves. So we had to stabilize our currency. And that much of it was done through the foreign reserves. So what you notice that our foreign reserves have grown to around 4.8 of import cover. That is one area that it went to. And then at the same time, we had issues of a drought. So much of it went to social protection. So you had issues of cash for work and these school programs that have feeding programs and all those things. And also you have also an increase in social cash transfer. So basically, much of that has gone there. So someone would argue that they are not seeing it, but basically that is the access that they had. And then on the other hand, now to finance the other deficit, they relied more on the domestic market. And I think the statistics will give you now a different picture. That was different with the past regime because they had access to the external market. It was during that time that we had 3 euro bonds that we borrowed, and we saw our debt portfolio actually grow beyond the levels that we are able to repay, to an extent that it was evident that in 2020 we were not able to actually repay our debt. So basically, data will tell you a different picture.
So data would then tell us that we've borrowed more now domestically than we were able to borrow in the previous administration. This administration has borrowed more domestically than the previous one.
So basically, what you're going to note is that when you compared what we borrowed during the previous regime and what we've borrowed now, is that data will tell you that we have borrowed less. But in terms of the activities of the government on the domestic economy, now the activities have increased. Why the activities have increased is that you have an issue where government, there were bonds and government securities that are always issued. And when those fall due, you have situations where you need to repay. So, and at the same time, every year you have a deficit in terms of your budget that you must actually account for. So then what you're going to notice is that every year a government will actually borrow more than they had borrowed before.
But when you talk about, you say there's been increased activity on a domestic level. Maybe let's quantify this, because, I mean, let's not assume that everybody understands what you're saying. When you say there's been more activity on a domestic level, just explain more on that in more detail.
Okay, so what you're going to notice is that when you look at the government actually puts up their plans to borrow through the annual borrowing plan. So when you look at the annual borrowing plans, what you're going to note, for example, this year, in the 2026 budget which is the coming year, we actually plan to borrow on the domestic market around 106 billion. So out of the 106 billion, there are about securities amounting to 84 billion that have matured. And those government will have to pay for them. That is refinancing of those. And then the extra 21 billion, government has to channel it to the 34 billion deficit that is in the 2026 national budget. So you find that what you're going to notice that that amount, the 106, is higher than what they planned to borrow in 2025, which was sitting somewhere around 78 billion. So what you note then is that because of that closure, government cannot have access on the external market. For them to actually finance the deficits, they have to rely on the domestic market. And I think that those are some of the issues that poses a challenge now.
Just on that also, because we've seen a lot. I mean, they've been contradicting statements on that.
Yes.
Others have agreed with it, that saying, you know what, if we have to finance a lot of our projects and so on, we need to look domestically instead of us borrowing externally, right? At the same time, people have complained that you cannot tax the Zambian people much higher, because this will also mean much more on the Zambian people here. And people have complained that that is not the most ideal situation, because already people are struggling economically, and then you want to tax them even more. So what is the JCTR really saying about this position?
So basically, there are two things that there are several ways in which government raises funds. So number one is that is through taxes. So that's the major stream of revenue, that is through taxes. And then we have the non-tax revenue. So these are dividends from the state-owned enterprises, and we have fees that government actually collects. And then beyond that, So you find that what the government plans then to spend is beyond what they're able to collect from both the tax revenue and the non-tax revenue, as well as the anticipated grants. That deficit will then be financed through the issuance of government securities. So basically, what you're going to notice that increasing revenue mobilization to finance our budget is a proper way of doing things. But then when we increase our activities on the domestic market in terms of going to using government securities to raise finances, that's where we have a challenge. The challenge that we tend to have is that these lenders on the domestic market, they will prefer the government more than to the local players. And so what you're going to see then is that other entities like private businesses will not have access to finances. And what that will tend to do is that the many drivers of growth anywhere in the world is the private sector. So when the private sector is crowded out of the market because of increased activities in terms of government borrowing on the domestic economy, then you might have a situation where you have growth that gets to stand. And not only that, what you're going to note is that when government increases its activities on the domestic market in terms of borrowing, you have a situation where lending rates will go up. And that's sort of a current situation that you are going to note. And furthermore, you have a situation where in order for government to actually finance that deficit, you have issues of taxes coming into play. And that is a situation that we noted there in the middle of this year, where government actually went back to Parliament to actually seek for a supplementary budget. And so those are some of the adverse effect of such activities.
Still on Zambia's debt profile, how would you describe Zambia's current debt position, and what do these figures mean for an ordinary Zambian?
Okay, so like I earlier on stated, so what you're going to notice is that currently our total debt position is sitting at around 27 billion thereabout. That is in US
kwacha,
dollars.
Or 27 billion dollars?
Yes. In kwacha, we are sitting at about 650 billion kwacha. That's our total debt. But out of that, 15.7 is public guaranteed, is the external debt, and then the 10 billion thereabout is the domestic debt. 1.3 is what government has actually guaranteed, bringing the total
just explain those numbers slowly. Our entire debt.
Our entire debt stock
is $27 billion.
As of June 2025, we are sitting at $27 billion.
External debt?
External debt, 15.7. And domestic debt, 10.2 billion thereabout. And 1.3 billion is what government has actually guaranteed through the SOEs.
Let's come to
so bringing the total to 27 billion, which is in kwacha 650 billion kwacha.
Again, external debt, you said, is standing at how much again? 15 billion. Yeah.
Yes.
I think it goes back to the question Chumaka asked. The previous administration tells us that the external debt they left was around 12 billion. Is that true?
So what you're going to notice is that external debt from 2020 to now has only increased by how much we received from the IMF.
That's 1.3 billion.
That's much of it, 1.7 billion. So the major part of it is what we got from there. So that is what has made the difference. So that is the only...
So what you're saying is there isn't much of a difference, really?
So, yes, because what you're going to notice is that the external debt profile only increased by what we accessed from the IMF. Because what happened is that immediately we defaulted, we became unattractive to investors. Our risk premium went high, and there's really no one that was willing to do a lot of business with us.
So what does this mean for myself and yourself and people watching this debt?
So, like I said, so what that means, it shows now in the budget allocations. So we have a situation now where our total budget, the budget that we have, the money that we plan to spend, is sitting at 253 billion. And out of that, we have 73 billion for debt servicing and 4.7 billion for dismantling of arrears. That brings our total servicing at 78 billion. That's around 31% of our total budget. But when you look at that 78 billion, for us to make sense out of that number, is that amount is far much higher than what we plan to spend on education, health, and social protection combined. So what that tells you is that we are now allocating more resources to debt servicing than we are allocating resources to education, health, and social protection.
Now, what's interesting from all of this is that, when we talk about debt restructuring, this was one of the celebrated milestones of the current government. When talk about, in fact, when President Hakainde Hichilema came back from, is it France? I mean, he had the whole tour from the airport to wherever he was going, waving at people, very excited, and said, this is a game changer. And we've heard this a lot from the UPND government, that debt restructuring is the best thing that has ever happened to us in as far as servicing our debt is concerned. But if we look at what it is, some people have argued that it's not what people think it is. In fact, what we're doing now is simply just postponing our challenges now to future generations. That, well, what we should have paid now, no, let's not pay it now. Let our children or our grandchildren pay it.
Okay.
Is that what the real position is?
So with debt restructuring, it gives us some temporary relief. So number one, you get to have a bit of some headroom. What that means is that instead of paying all your debt that is due at that particular time, you have, because in the restructuring, there are two things that happened. Either you get your principal a bit cut, or you extend your repayment period. So what happens then is that instead of paying so much at that moment, you reduced on your repayment. And so you have a bit of room for you now to channel such the extra resources to the other sectors that needs that. But beyond that, what you do is that since you're with a default, you become unattractive, that actually also affects your investor confidence. So you have investors not willing to do business with you. So when you are going to a restructuring, there is some sort of confidence that you then build in terms of a country. And that then you have investors willing to bring in their investment. And so the upside of it, which is the advantage of it, is that what we've noted is that we have bought a bit of headroom where we are able now to allocate resources to deal with issues of social protection. We have social cash transfer continuing. We have issues of cash for work, and we have all these school feeding programs. That is one side of it. Another side of it is that...
Although, by the way, we've seen now whether it's suspended or temporal cutting off of cash for work.
Yes.
From the Ministry of Local Government and Rural Development just recently announced that they are suspending that because they are owing, and there's so much going on regarding that.
I think it's basically that one now sits on the issues around administration, but the program itself it addresses the critical issues of social protection. And then the other thing that you note is that the issues of investor confidence, and that's the reason why you saw a lot of investments being unlocked in the mining sector, and that comes with the confidence that you bring through the restructuring. But the downside of it is where now, because we have a debt restructuring is not a cancellation, we still have to continue. So those that we have restructured, we must service. So what that tells you is that your service amount increases. So because when you're in default, you're not paying anything in default. But when you bring these investors on the table, you agree on a restructuring program, you need to resume your debt servicing. And so what that tells you now then is that that servicing is that you need to allocate a lot of your resources there. And that may, in the process, if your domestic revenue mobilization is not robust, affect how much then remains for you to spend in other critical sectors. So that becomes the downside of it. But it all depends on how you play out the two sides of what sits before you. Because what you note is that if you have increased investor confidence and you have more investment coming, that simply means you have more economic activities, and that simply means you can grow the proportion of your revenue in terms of your collection, because your base would have actually improved. And with that improved revenue, you must be in a better place.
And the numbers so far look good, isn't it? We are growing by 5.2 on average and expected to grow by 5.9 as of December. Do these numbers look impressive for you in terms of us juggling between debt and the economic activities within the country? So
the major hurdle that we've had is that we seem to be the economy seems to be coming out of the ICU, and we are beginning to witness an increase in economic activities. But the major challenge is that there has been little of issues being felt basically on the ordinary citizens, because I think the cost of living still remains elevated. You appreciate that, and then we still have issues around, I think, those that may want to undertake a number of activities. I think it's just recently where we saw some adjustment in terms of issues around load shedding, so that we have activities in the low-income compound so that they continue to actually produce. But what you're going to note is that we have not yet grown. The economy is not yet growing at a rate that growth should actually translate into a tangible improvement in the livelihoods of the people.
And I think this is what doesn't make sense to the people. Because if you're going to compare the two regimes, the previous regime, the economy was growing in the negatives, inflation was very high, nearly the economy, like you said, was in ICU, but relatively, the cost of living was a bit affordable. Fuel was cheaper, minimum was much more cheaper than it is today, and all these things. Today, the economy is pointing in the right direction. The economy is growing at about 5%. Inflation has reduced, the currency is appreciating, but yet the people can't see the things that this economy must bring about. Yet with a broken economy, one would argue that things were much better.
And then people would argue that money was in circulation at that time, and now people don't feel the same way about that. How
for a fixed economy.
How can that be justified?
Interesting. So what you're going to note is that these things that have been at play. So number one is that we've had subsidies in terms of fuel. And what you're going to note from the fuel subsidy is that fuel is not just used mainly in these motor vehicles and all those things. It becomes much of a factor of production. And because it's one of the input in terms of your production, then you have your production being relatively cheaper. But we have realigned our subsidy program, where we've moved more money from the fuel to education and all those things. And so what you have done now is,
you think that's a smart move?
I am going to explain. So what that means is that then you are moving towards a cost-reflective economy in terms of cost, in terms of activities. So what I'm saying is that before then, so things looked relatively cheaper because we had a situation where we were not mirroring the actual cost in terms of production. And so the challenge with that is that now when we come now, you find that as a country, we have areas that are sitting at around 80 billion kwacha. In terms of dollars, we are sitting at slightly above $3 billion. And you find that part of that cost are expensive fuel areas. So the challenge with the fuel areas is that you have situations where these have got an interest component of it. So you find that as long as you do not dismantle it, it grows quickly. But then you have that negative effect. So what we were enjoying then, we are now paying now.
No, but you see, and that's the thing where we're at as a country, because you have a number of citizens who say, well, that's the responsibility of the government, really. That's why we have these people in power, that they should make our lives easier, and they should make those costs easier for us. Insured subsidies, and people have gotten used to that. Well, some people have gotten used to that for a very long time. If you look at where we're coming from the UNIP days, the MMD days, where we started seeing these Boma and Anganepo kind of statements, it seems people have gotten used to the government always intervening when it comes to the costs they have to pay for essential commodities. Should this now be halted? Should governments going forward just be very realistic, where they say, you know what, this is what the actual cost is, and we as a people should pay for this? Or should the government come in and say, well, this might be expensive for you as a people, but let's help you cushion this cost? And I would like to hear this from you as just a Center for Theological Reflection, because a lot of the work you do is centered around the people. What are your thoughts around this?
So basically the focus of the government is to protect social protection. So what you're going to notice that with the removal of fuel subsidies, because the argument there is that you find that ultimately those that benefit from these are not only the marginalized or the vulnerables, but even those that can afford. So now what government does is move this and move it towards social protection, where you have some sort of targeted initiative. So you have cash for it program, where you know that those that you're targeting are really vulnerables. You have the social cash transfer, where you know that those that you're targeting are really the vulnerables. So you have that situation then. So that is the situation that you tend to paint. So you are avoiding a situation where you put up this program and it's also benefiting those that do not really need to benefit from it. And so now government has to realign to ensure that you actually target those that are in need. So basically within this, you are able to see that you have some sort of a targeted program where people that really need this help are the ones that are rich.
So, and actually, that's been corrected that you're actually from the Center Trade for Policy and Development, CTPD, but it's still, because it's still under civil society, and you still make a lot of these advocacy. And I know you work together really as organizations. But where do you stand? What's your actual policy direction? Are you pro governments making these interventions, or are you pro citizens being aware of the costs for these commodities and so on, and being able to pay for it, and being ready to really put out the money so they appreciate the value for some of these things that they get to consume in society?
Okay, so I'll give you an example to just clarify, to put context to our position. For example, the issues around electricity.
Yes. So
you have subsidized rates. You get that. So with the subsidized rates, the investment in the energy sector is unattractive.
Yes.
So no one can come and then invest there. So what you have then, you have one entity that is a key player. And because they're offering you a service at a subsidized rate, there's no room to expand, there's no room to invest in infrastructure, and then you have extended breakdowns and all those things. And what you see then is that we have an issue where we have a crisis in terms of power. So from the Center for Trade Policy and also from CSO Debt Alliance, our considered view is that in terms of, I'm giving an example of issues around power. If we move to the cost reflective tariffs, where all subsidies are actually out of the picture. You have people paying for the power that they're using. What you would do then, you make that sector more attractive. And then you have more investors come into play. And then when you have more investors come into play, you actually push issues around the competition. And with competition, you have efficiency, and you even have an issue around the cost coming down. So what you're going to notice that when you get to a place where you now have cost-reflective tariffs, you have many players on the market, you are able to generate enough. And when you're able to generate enough, people will have, they will forget about load shedding. And so economic activities can go on, and the economy can actually grow. So from where we stand is that we advocate for pro-poor policies, but where a subsidy benefits more of the rich at the expense of the poor, that becomes a challenge. Because, for example, when you look at our power, 60% of it goes to the mining companies. And so if you charge that rate to what you're charging everyone, you have those players benefiting more than the local.
The strange part is that a lot of these subsidies we see, the rich feel that they're actually the ones who benefit less, or they're the ones who get to put out more. I mean, even if you look at, for example, I know there's been a lot of talk around the national health, the management of the national health insurance policy, NEMA, in other words. A lot of those who are more privileged feel that, for example, they are the ones who have to pay much more for the less privileged, for example, because some of them have their own private schemes, but it's mandatory because it's an act of parliament. They have to have those deductions going on and so on, and they feel that they are the ones who have to fork out much of that bill. So that's but one of the examples that some of them would give, that they have to do that. So isn't it the other way around, really, that we have a lot of these policies that have these deductions from those who are more privileged in society? I don't really say rich, but just say more privileged in society, because maybe they're employed and so on. They have a stable source of income compared to a good majority that don't have that kind of privilege.
Not necessarily that. What you're going to notice that basically everyone tends to contribute based off how much they're able to make. So basically the issues that are at play when you are administering something in terms of a percentage, it deals with issues around principles of equality. So those that are earning more contribute more than those that are earning less. So basically that is what you see.
Well, let's get back to the issues of debt. You ably explained on the extended credit facility and how much this has been more or less like a hindrance because of the conditionalities that has come with it. $1.7 billion was given to us as a country. We are aware that it's about to wind down, and from the coalition, I would like to find out what strategies should this country put together or adopt to manage the transition period sustainably.
Okay, so what you're going to notice that first, we put some context there. What you're going to notice that government has shown interest to try and actually extend this facility. And because the talks were not yet completed, the IMF actually had extended the period by 3 months to just allow them look at this and see if they should extend this facility. But I think what we must do to transition and move more fairly, to more sustainably, I think the major issue should be looking inwards. So what do we mean by looking inwards? I think that there is need for us to become more efficient in our domestic revenue mobilization. What you are going to appreciate is that I think in the last 3 years, there has been a lot of transformation that has been done under ZRA. They have almost digitalized all their systems in a bid to try and improve efficiency. But despite that, we still continue to see signs of leaks. So one of them is the FIC report gives us a good picture of what is happening in the extractive industry. So you have this year, the report told us that last year there was some suspicious of potential loss of around $3.5 billion as money that leaked out from the extractive. So what that tells you is that despite us getting to improve and becoming more efficient, there is still that potential of us losing revenue. So that 3.5 billion, putting it into context, at that time it was sitting at about 89 billion, and that would cover the budget that we're talking about in 2026 for health, education, and social protection. And not only that, when you look at the direct contribution of the mining sector or industry, and then you compare that one to the contribution of those that are contributing pay as you earn, the employees, you're going to find that the direct contribution of the mining sector, both the corporate income tax as well as the what we get from the mineral royalties,
is less.
when you combine that and compare with pay as you earn, you'll find that pay as you earn contributes more than that. So what that tells you is that, furthermore, you are going to know that pay as you earn is actually a single most high contributor tax, which contributes the highest to the revenue envelope. So what that tells you is that you are seeing a situation where there is actually room for us to be more efficient in terms of growing our revenue base if we keep the leaks that are in the extractive just alone.
Taxing the mines more, don't you think then that creates an environment that is not attractive for investments? Because also the argument is that, yes, indeed, the mines, the pay as you earn might be higher than what the mines contribute to our budget, for instance. But it's the same mine that employs these thousands of people that are still contributing pay as you earn. And so ultimately the equation still goes back to the same.
I think figures will tell you a different picture. Figures will tell you different pictures. The argument that is advanced mainly is on the indirect benefits that the mine actually have. And one of those is that you have issues of procurement, where the mine actually extend these activities to the locals and all those things. But basically, our understanding is that most of our minerals, these are depleting assets. So the copper that we may be mining now, in the next 30 years, 40 years, may not be there. So when this copper is not there, the question that you ask is, out of the copper that went out of the country, what is it that you did with it? That those are issues where the future generations would ask. So then it is incumbent upon us to ensure that despite the mining sector having those linkages that we have, the indirect linkages, there must be some sort of tangible benefits that we are getting as a people.
Do you have examples of countries that are following the equation in its right format that we can point to?
So what you're going to notice that I think the case in point is the situation that we begin to see in Botswana, where the country seem to feel that despite them owning the gold, they are not getting a fair share of it, and they're trying to put up changes to ensure that they participate more and get more tangible benefits from there. So those are some of the issues. So what you're going to notice is that in a country like ours, there are minerals that are more capital intensive. Those we can not be able to undertake, but there are activities that are less capital intensive we may have more control. Of those
control.
ones. Yes.
You, from the time you came here, you've consistently been mentioning of the fact that from your research, we have allocated more money for debt servicing, and this is outweighing the combined budget for education, health, and social protection. I'd like to find out from you what the long-term implications of prioritizing debt servicing over education, health, and social protection is.
So the long-term implications are clear. So number one, the ultimate implication would be you would have a situation where you have growth that is stunted. So in terms of the specifics, what you're going to notice that allocation to education, health, and social protection has what we call the multiplier effects. So what you have is that if you allocate proper resources to the education sector, health sector, what you're going to have is that you're going to have the right skills. So you have enough resources where you train your people, and they'll have the right skills. With those right skills, they can then become more effective and productive to contribute to the development of the country. And with that contribution, then you're going to have improved productivity, and that will translate into growth. And then the inverse becomes true. So now when you allocate a lot of resources in the long run to debt service as opposed to these sectors, what you're going to have is that with that, you are going to have a lot of enrollment going into schools, but you cannot recruit more of your teachers, you cannot build more of your infrastructure, you cannot put up more of learning materials. So what then you have is that you have a lot of these learners in school, but there's no the materials for them to learn. And then what you're going to have is that you will have people that do not have the skills, and that will affect your productivity. In terms of health, what you're going to see is that with less investment in the health sector, then that increases out-of-pocket expenditure, because now people will have to access these services from the private healthcare service providers, and those will require them to pay. And it's not like government is offering that service. So what you're going to see is that then increase the inequalities, and then that will also affect in terms of the kind of a population that you have. So if you have a population that is not health, then your population cannot be as productive as the population that is health. And that then affects your economic activities. And when that is affected, then you have growth that is stunted. And then the challenge that you have is that your growth, which is the GDP, is sort of a stake where you actually get your tax. And that is the money that you need as a government to run the country. And so with the growth that is stunting, then you have a challenge in terms of your revenue mobilization strategy. And then you have again to go more and rely on debt. And then you bring a country to its knees in terms of defaults. And those are the implications then that we then get to have if we go, we rely more on debt servicing without actually balancing with issues around.
Did you foresee this happening to our country? Because obviously this date that we've structured is over a couple of so many years. Also, does the coalition foresee this continuous exercise of recruitments that has been coming from government now that we are repaying, we are servicing our debt because we've managed to restructure? And obviously this is going to go on for so many years. Do you foresee the initiatives that this government has started of recruiting yearly health workers, teachers, and other professionals?
So basically the continuation of that will depend mainly on our domestic revenue mobilization. Because what we're going to have is a challenge that as we increase, as we finalize on issues around the date that we've accrued in terms of our structuring, that obviously will come with an increase in terms of how much we need to repay. And government has two priorities. So the priorities for government is that it needs to meet all its obligations in terms of debt. And it also has to meet its obligation in terms of the wage bill. So the focus then becomes meeting the debt obligations and the wage bill obligations. And in our current state, what you're going to notice is that when you take our debt service amount and you add what we are spending on our debt bill, on our wage bill, we spend over 50% of our total budget on those two items. So what you see then is that every one kwacha that government allocates in terms of what they need to spend, 55 way of that goes to paying the wages as well as servicing debt.
No, it has much as you say that. I know because you're coming from CSO, and I understand perfectly because you look at it from the technical side of things. But I mean, for example, going into an election year, and you spoke of the two aspects of how government look at the wage bill, and you're looking at servicing debt. At the same time, the same government, especially that they come from a political party, will be looking at securing an election, and sometimes is that the voices of the people that maybe come into play, and maybe wanting to appease or appeal to the people there. How much of effect does this have, really, especially when it comes to how our domestic expenditure is concerned?
So basically what you're going to notice that what has been observed over time is that governments tend to spend more in an election year. And basically much of it is to make sure that voters are sort of comforted and all those things. And I think that was some of the expectations when the budget was being announced. So people were thinking, pay as you earn. We are going to have some threshold increase there. But I think what we saw was an increase in CDF. Yeah. So basically, what you're going to note is that with the challenges that CDF has given us, we hoped to see a situation where we were supposed to leave the CDF at 36 and then try to deal with the bottlenecks that CDF
that
had.
Increased to 40.
Yes. Why that is so is that you find that CDF has been a game changer in terms of driving the decentralization agenda of government. But what you're going to note is that in terms of different programs under CDF performing, they have not really performed to expectations, and so there are a lot of bottlenecks that needed to be addressed there first before increasing. So what I'm saying is that we are likely to see a situation where CDF begin to be used as a tool by politicians to actually secure votes.
Now, if we look at what's been happening across the world, I mean, we can look at it even from the African continent. Are there examples we can make reference to of countries that have managed to create this balance, where you have this issue of debt that's being managed, restructured successfully? At the same time, you're also managing social expenditure, because the people still will be looking at results in as much as, because they're suffering. People are still suffering, and again, the government will also have a hard time in suspending a lot of these social protection programs. Do you have examples of this, realistic examples across the world?
So what you're going to notice that I think a country that stands out best in balance in these two is a country like Rwanda. So you have a situation where you are meeting all your debt obligations, but still meeting your benchmark allocations towards the critical sectors. So I'll give you an example. So under the Abuja Declaration, countries, the African heads of states in 2001 agreed that they will allocate at least 15% of the total budget to the health sector. So you find that in Rwanda, almost 15% of the budget goes to the health sector. So you have, under the Maputo Declaration, where there's an agreement of allocating at least 10% of the national budget towards agriculture, looking at its role that it plays in terms of development. I think it's able to meet those obligations. In our case, we are not. When you look at the education sector, the best standard is that we commit to allocate at least 20% of our budget. Currently, as a country, we sit at 13%. But when you look at this country, they're able to actually meet that. So it is possible we can balance up, but basically that comes with a lot of fiscal consolidation. What do we mean is that there, in as much as we grow our revenue base, because what we see is that for the last 5 years, ZRA has been meeting and exceeding its target. So meaning, in terms of revenue mobilization, every year we are improving. But at the same time, on the expenditure side, the appetite to spend keeps on growing. So what then you see is that because there is that growth in the appetite for us to spend, we keep then to compensate the deficit by borrowing more. So we must get to a point where, as we become more efficient in our debts, in our revenue collection, we also control issues around our expenditure so that there is that balance, so that our fiscal deficit begins to actually reduce.
Looking ahead, what immediate reforms should government prioritize in 2026 to keep debt levels sustainable?
So I think I decided to speak to that one. So what you're going to notice is that issues around fiscal consolidation. So meaning our fiscal deficit must be kept within the range that is sustainable. So the benchmark is that we must not be spending, we must not have a fiscal deficit that is more than 2.1%. So what you're going to notice is that the good news with the 2026 budget, I think what we notice is that government is committing that they're not again going on the external market to borrow anything. We are going to, everything that we are going to have, apart from the disbursement that is coming in from what they had already borrowed, is what will sustain that one. So our net growth in terms of our debt our debt is likely to grow by 19 billion.
In conclusion, Mr. Mwale, what role can civil society and citizens play in holding institutions accountable for debt management?
I think the major issue is that we must begin to provide guidance as well as advisory services to the government through issues around advocacy, as well as when we generate this evidence, call these the powers that be to the table, have those discussions with them, make them understand what we are saying, and seek to actually guide them in how best we can navigate around this. I think basically it's issues around advocacy and just letting them understand the implications if we do not adhere to the plans that we've set forth.
Mr. Robert Mwale, the coordinator of the Civil Society Debt Alliance, thank you so much for making time to join us on tonight's edition of this special edition of Diamond Live.
Thank you, Mwansa, and thank you, viewers.
All right, so we've been discussing the 2026 national budget and Zambia's public debt management. Thank you so much for being a part of the program tonight. See you again on Wednesday at exactly 21:15 hours. My name is Andrew Mwansa.
My name is Yuboida Chilashe. Enjoy the rest of your night. Up next is the Stephen Piri Show. Good night.